Most people hear the phrase average net worth and immediately assume it represents a realistic benchmark for where they should be financially. But what they don't realize is that this number is heavily distorted by a small percentage of extremely wealthy individuals who pull the average far above what most people actually have, which means if you're comparing yourself to that figure, you're not measuring yourself against reality. You're measuring yourself against an illusion that was never designed to reflect the typical person's situation in the first place. And this is where a lot of unnecessary stress begins, because someone could be doing objectively well, saving money, investing consistently, avoiding debt, and still feel like they're behind simply because they're looking at a number that doesn't represent the majority. The difference between average and median is everything here, because the median tells you what the person in the middle actually has, meaning half the population has more and half has less. And this creates a much more accurate picture of financial reality, but even then, relying too heavily on any comparison metric can still be dangerous because it shifts your focus away from what truly matters, which is your own trajectory, your own habits, and your own progress over time. Because wealth is not a snapshot, it's a process. And if you reduce it down to a single number at a single point in time, you lose the entire context that actually determines long-term success. Someone could have a higher net worth today purely because of external factors like inheritance, timing, or even luck, while someone else might have a lower net worth but a far stronger financial system in place, better habits, higher income potential, and a long runway ahead of them, and over time, the second person is far more likely to build sustainable wealth. But if you only look at the numbers today, you completely miss that distinction, and that's why comparing yourself to averages is not just unhelpful. It can actually push you in the wrong direction by making you prioritize short-term appearances over long-term strategy. What actually matters is direction, not position, because direction determines where you're going, while position only tells you where you are right now. And if you're consistently moving forward, saving more than you spend, investing regularly, increasing your income, and making smarter financial decisions year after year, then your trajectory is positive, and that's the only thing that truly compounds over time, because small improvements repeated consistently will always outperform random bursts of progress followed by periods of stagnation or regression. The problem is that most people don't track their trajectory. They only look at their current situation, and when that situation doesn't match what they think it should be based on some average statistic, they feel discouraged, even if they're actually on the right path. And this discouragement often leads to poor decisions like trying to catch up too quickly, taking unnecessary risks, chasing trends, or abandoning proven strategies in favor of shortcuts that promise faster results but usually come with higher downsides. Another issue with focusing on averages is that it ignores the individuality of financial journeys, because everyone starts from a different place with different opportunities, responsibilities, and challenges, and trying to force your situation into a generalized benchmark doesn't account for any of that. Someone supporting a family, dealing with debt, or living in a high-cost environment will naturally have a different financial timeline than someone without those constraints, and yet the average number treats them as if they're all operating under the same conditions, which creates unrealistic expectations and unnecessary pressure. When you shift your focus from comparison to trajectory, everything changes, because now instead of asking, am I ahead or behind, you start asking, am I improving? And that's a question you can actually control, because improvement comes from actions, and actions are within your control, while averages are not. You don't control what other people earn, save, or inherit, but you do control how much you spend, how much you invest, and how you grow your income over time, and those are the variables that actually determine your financial future. Consistency becomes the most valuable factor in this equation, because it removes the need for perfect timing or extraordinary luck. If you invest regularly, even in small amounts, those contributions begin to build momentum, and over time that momentum compounds into something significant. But the key is staying consistent even when it feels like nothing is happening, because in the early stages, progress is slow and often invisible, and this is where most people lose patience, especially if they're comparing themselves to inflated averages that make their own progress seem insignificant. The reality is that wealth building is supposed to feel slow at first, because compounding takes time to become noticeable. And during that time, the only thing that keeps you moving forward is your system, your habits, and your discipline, not external validation or comparison, because those are unreliable and often misleading. And if you rely on them, you'll constantly feel like you're falling short, even when you're doing exactly what you should be doing. Focusing on your own trajectory also allows you to make better decisions, because you're no longer trying to match someone else's timeline. Instead, you're optimizing your own, which means you can prioritize stability, sustainability, and long-term growth over quick wins or risky moves. And this leads to a more resilient financial position, because it's built on fundamentals rather than reactions. Over time, This approach creates a compounding effect not just in your investments but in your behavior, because every smart decision reinforces the next one and every improvement builds on the previous one, creating a cycle of progress that becomes increasingly powerful as time goes on. And this is something averages can never capture because they don't show the path, they only show a distorted endpoint. The biggest advantage you can give yourself is clarity, understanding that averages are not benchmarks you need to chase, but rather rough data points that lack context. And once you stop giving them so much importance, you free yourself to focus on what actually moves the needle, which is consistent action over time. Because at the end of the day, your financial success will not be determined by how you compare to an average, but by how effectively you build and maintain a system that continuously moves you forward. Most people think their financial progress is determined by how much they earn, but in reality, the three variables that matter far more than any paycheck are how consistently you invest, how well you control your spending, and whether your income is actually growing over time, because without these three working together, even a high salary can quietly disappear without building any real wealth. And this is where a lot of people get stuck. They focus on increasing income while completely ignoring the systems that allow that income to turn into long-term net worth. Consistent investing is the foundation of everything, because it's the mechanism that transforms earned money into working capital. And the key word here is consistent, not occasional, not when it feels convenient, not when the market looks safe, but consistently regardless of external conditions, because the market will always fluctuate, there will always be uncertainty, and waiting for the perfect time to invest usually results in doing nothing at all, which is the most expensive mistake someone can make over a long period of time. When you invest regularly, you remove emotion from the equation because you're no longer trying to predict short-term movements. Instead, you're participating in long-term growth. And this approach benefits from something most people underestimate, which is compounding, because every dollar you invest has the potential to generate returns, and those returns generate their own returns, creating a cycle that accelerates over time. But this only works if you give it enough time and consistency to develop, because compounding is not linear. It starts slow and then gradually builds momentum, which is why people who start early, even with small amounts, often end up far ahead of those who start later with larger sums. At the same time, investing alone is not enough if your spending is out of control, because your ability to invest is directly tied to the gap between what you earn and what you spend. And this is where controlled spending becomes critical, not in the sense of restricting yourself from everything, but in being intentional about where your money goes, because every dollar you spend is a dollar that cannot be invested. And over time, those missed investments represent not just the initial amount, but all the future growth that money could have generated. Lifestyle inflation is one of the biggest obstacles here because it happens gradually and often goes unnoticed. As income increases, expenses tend to rise alongside it, and before long, the additional money that could have been invested is absorbed into a more expensive lifestyle, leaving little room for actual wealth building. And this creates the illusion of progress, because externally it looks like success, nicer things, better experiences, but internally the financial foundation remains weak because assets are not growing at the same pace as income. Controlled spending doesn't mean cutting out everything you enjoy. It means prioritizing what actually adds value to your life while minimizing unnecessary expenses that don't contribute to your long-term goals. And this balance allows you to maintain a good quality of life while still creating room to invest consistently, because ultimately the goal is not to deprive yourself, but to align your spending with your priorities so that your money is working both for your present and your future. The third component, income growth, ties everything together because there's a limit to how much you can reduce spending, but there's far more potential in increasing what you earn, and this is often overlooked because it requires effort, skill development, and sometimes stepping outside of your comfort zone. But increasing your income expands your capacity to invest, which accelerates the entire process of wealth building, especially when combined with controlled spending and consistent investing. Income growth can come from multiple sources, whether it's advancing in your career, learning new skills, starting a side business, or finding ways to create additional streams of revenue. And the more you diversify your income, the more resilient your financial situation becomes, because you're no longer relying on a single source. And this reduces risk while increasing overall earning potential, which feeds directly back into your ability to invest and build assets. When these three elements work together, they create a system that compounds over time, because consistent investing ensures that your money is growing, controlled spending ensures that you have money available to invest, and income growth increases the amount you can invest, creating a feedback loop that becomes more powerful as time goes on. And this is why these factors matter more than age-based benchmarks, because they determine the rate at which your net worth grows regardless of where you start. Someone who begins with a modest income but focuses on these three principles can build significant wealth over time. time, while someone with a higher income who neglects them can struggle to accumulate assets despite earning more. And this highlights an important point, which is that financial success is not about how much money passes through your hands, but how much of it you retain and grow, because income is temporary, but assets are what create long-term stability and freedom. Another advantage of focusing on these principles is that they are entirely within your control, unlike market conditions, economic cycles, or external comparisons, which means you can take action immediately without waiting for the right time or the right opportunity, because the system itself is what drives results, not any single decision or event. And by consistently applying these principles, you create momentum that builds over time, making it easier to continue progressing even when circumstances change. The longer you maintain this system, the more noticeable the results become, because in the early stages, progress can feel slow and almost insignificant, but as investments grow and income increases, the effects begin to compound, leading to larger gains that require less effort to sustain. And this is where the system starts to feel less like work and more like a natural progression, because the habits are already in place and the momentum is already established. Focusing on consistent investing, controlled spending, and income growth shifts your perspective from short-term comparisons to long-term strategy, because instead of worrying about where you stand relative to others, you're building a system that ensures continuous progress. And this approach not only increases your net worth over time, but also provides a sense of control and clarity, because you're no longer dependent on external benchmarks to validate your progress. Instead, your progress is defined by your own actions and the consistency with which you apply them.